Okay, now in this discussion, we are going to understand overview of the chapter mergers, acquisitions, and corporate restructuring. From exam point of view, as well as from practical point of view. Of course, if you join M&A division of Big Four and all, or even big companies like Infosys, Facebook, they'll always have this M&A division. And you also would have addressed this by already now, because wherever you go, this chapter follows, whether in intermediate accounts, advanced accounts, or at final level in the accounting FR chapter, old syllabus, new syllabus, FR syllabus, SFM, everywhere this chapter follows. So merger is definitely order of the day. Be it Facebook acquiring WhatsApp or Reliance acquiring Future Retail, there is no end to it. Vodafone Idea, for different reasons, mergers are required. So we will not go to the explanation much of why merger is required. Uh, it is important. Merger is mainly having the benefit of large scale production, and merger also have a disadvantages like cultural differences might come, just like a marriage, right? It might be successful or it might be failure for different reasons. And we have types of merger like uh, vertical merger, horizontal merger. Horizontal means within same industry, Vodafone Idea. Vertical merger means one company being customer of other company, then they are getting acquired. That is like horizontal. Then conglomerate, where there is no connection. That's the types of merger we have. And in theory question can come due diligence, where before you acquire a company, you will ensure that there is no problem with the company, either taxation wise or financially or labor wise. That is called as due diligence check. Then demerger problems. Theory part, again, as I told you, I've covered in detail in the essay theory marathon. Please search in the YouTube, you will get it. Please watch it at your convenience. Now let us focus on the problems which will be asked and what uh, preparation we have to do, what are the formulas that we should be aware of conceptually. And in every exam, merger, even though we are not spending much of time as compared to other chapters, it is definitely important. Every attempt, it is 10 to 12 marks. Problems plus theory is almost guaranteed. Okay, so what are the names that we have to give that we should be aware of? When one company acquires another company, for example, company A acquires another company, company B. Company A, in this world, in SFM world, financial management world, we call company A as acquirer and company B as target. B is being acquired, and together after merger, it is called as this. This is pre-merger. Acquirer is the acquirer who is taking over the company. Target, which company is being looked at for being taken over, and once acquisition takes place, it's called as merged entity. Merged entity. So this is the basic name that you should be aware of. Now, what are the calculations that will come here, and what are the formulas that will come? We will go through one by one. Please take the notes along with me. If A acquired B, A is called as the acquirer, B is called as the target, and together it's called as merged entity. Now, for the purpose of acquisition, you take over the assets and liabilities. You take over, that is, A takes over B. Means what? All B business will be transferred, right? Business transferred, taken over. Business transferred means control transferred. Control transferred means shares will be given to A, or whatever the understanding. Assets and liabilities will be given to A. But you should give as one compensation. What the acquirer gives is called as purchase consideration. What the acquirer gives is called as purchase consideration. And you must be aware of it. And it's always give and take policy, double entry system. You get one benefit, I get one benefit. The purchase consideration, you can also say cost of acquisition. Cost of acquisition. That is what you are paying to get the shares. Acquiring, you are paying so much of amount, purchase consideration, amount paid towards acquiring a company, cost of acquisition. And this cost of acquisition can be by issue of shares, or it can be by payment of cash. By issue of shares or payment of cash. Okay, when you make issue of shares, there is something called as a swap ratio you have to calculate. Swap ratio you have to calculate. What is swap ratio? Also called as exchange ratio. What you're doing, you're getting the control of B company and you're giving your issue shares, which means you're acquiring B company shares and you're giving your own shares. The target company shareholder becomes the acquired company shareholder, that is in the merged entity. So swap ratio is for example, swap ratio is 2:1. For every one share, 2 shares are issued. Swap ratio, I'll give a formula here. Let's write down here. Swap ratio is number of shares issued, or whatever number of shares issued, divided by number of shares of acquirer company issued. Number of shares of acquirer issued or issued by acquirer. Number of shares issued by acquirer. Number of shares issued by acquirer for number of shares held in target company. For example, if the ratio is 2:1, if you have 1 share, we will give you 2 shares. For every 1 share held, we will give you 2 shares. Now, payment of cash, no swap ratio. And swap ratio can be based on earnings of the company, can be based on market price per share of the company, can be based on any other ratio, can be based on book value of the company. Now, so swap ratio can be based on any basis, and it can be average also. It can be average also. So if it is based on earnings of the company, what will happen? Earnings of the acquirer, earnings of the target, I see number of shares will be this, parameter will be opposite. I will write in the next slide. Hope you have taken down this. This is the number of shares formula. But if the earnings base is given, EPS base is given, uh, or a book value base is given, then formula will be slightly different. I'll write in the next slide. Okay. Now swap ratio, that is the number of shares issued formula. But swap ratio may be based on some parameter like earning per share. So there what you're going to do, you will write like this. For example, a parameter of target company divided by parameter of acquirer company. You can remember like TA. What is TA? T in the numerator, A in the denominator. Like it may be earnings per share, it might be market price per share, it might be book value per share, or it might be any basis like bad debts ratio. You will have capital adequacy ratio if it is a banking merger, anything. This is regular formula. But if the ratio is inverse, what do you mean by ratio is inverse? If the bad debts is the ratio, if NPA is the ratio, non-performing assets, so in that case, if higher ratio does not mean good, higher ratio means bad. So when parameter is risky. When parameter is risky, like NPA, non-performing asset, applicable in bank merger problem. So when the parameter is risky, like non-performing asset, then the formula will be reverse. Then the ratio, the above ratio will be reverse. Above ratio will be inverse. Reverse will be inverse. When the parameter is risky, like non-performing assets, the formula will be reverse. Means what? A parameter of target by parameter of acquirer. But in general, this is the formula for swap ratio, also called as exchange ratio, applicable only when purchase consideration is settled by cash basis. Purchase consideration is not by cash. Purchase consideration is by issue of shares basis. And in this case, the ownership is altered. In the swap ratio, ownership is altered. You understand, right? When you issue shares, the acquirer company shareholder will be joined with target company shareholder because they will have the shares of a merged company now. So their ownership will be diluted. But if you issue the consideration on cash basis, ownership will not be altered. A previous number of shares after merger also, there will be same number of shares when the purchase consideration is issued by cash basis. And one more thing can happen, just be aware of it. When payment of cash basis, there might be interest cost. There might be interest cost involved. What is the interest cost involved? What is the interest cost involved? Uh, you are acquiring a company and you have to make a payment by cash. If you don't have a cash, you might take a loan. And for that loan, you have to pay interest. So what kind of questions you will get in exams? Should the merger happen? Merger chapter in SFM is always a decision making chapter. See, you are acquiring a company, their profits becomes your profits. And for which you have to you have to settle the purchase consideration. Money you don't have, you take a loan, you pay interest. So what is the benefit you are getting? The profits of that company. And what expense you are incurring? The interest paid on loan to be payable to acquire the company. So profit is your benefit, interest is your expense, and you make analysis whether the interest exceeds the profit. That is cost is more or benefit is more. Accordingly, you will make the decision. So it's sometimes also called as a levered buyout. Levered buyout. There is one more thing that is going to come here. It's called as the maximum exchange ratio, minimum exchange ratio. I'll discuss it little bit later. Before that, I would like to discuss few more points. Then I'll come to the this swap ratio, minimum and maximum exchange ratio. Because merger is done mainly to get the benefits. So, what are the benefits that you should be aware of? Benefits applicable to mergers. It's called as synergy. Synergy in benefits. Synergy. What do you mean by synergy? Synergy is synergy in earnings. Synergy in earnings means saving in expenses. Saving in expenses due to merger. Due to merger. You know the benefit of benefit of large scale production. When two companies come together, their expense will be saved because they can purchase more. You can get more discount from the suppliers. You can produce more. So cost per unit will come down. Efficient utilization of resources, saving in expenses. That is due to merger. So that formula is given by earnings of merged entity. Earnings of merged entity minus earnings of before merger, that is earnings of acquirer plus earnings of target. Correct? So this is before merger. This is like earnings of merged entity A, B, earnings of acquirer A, earnings of target B. So before merger, what your earnings A, what your earnings B, if I add both, but if you're together, AB is more than your individual earnings. Individual earnings of acquirer 5,000. Individual earnings of target 3,000. So if they're independent, then it will be 5,000, 3,000. They can make only 8,000, 5,000, 3,000. But if they come together they can make a profit of 9,000. So individually they can make 5 plus 3, 8,000. But together they can make 9,000. So 1,000 is synergy benefits. Even in movies you would have learned, right? In a multi-star movies, two hero will be there. So one hero will be fighting, other will be fighting, but if they come together, they can destroy the villain's den and all efficiently. Same thing. You write the exam, your friend write the exam, you get individual marks, but if both of you write the exam together, cannot happen. But if you write together, you are going to get more marks. That is what is called as synergy, benefit of coming together. Okay. Then we have synergy in valuation. Same thing, same formula. Synergy in valuation. That is uh, synergy in overall value. This is earnings, expense during to merger. This is for a year. Savings in expenses is for a year. So this is the incremental benefits in present value. Incremental benefits in present value. In present value. Basically, the savings will come only 1 year, second year, third year, right? If all the synergy benefits, if I take a present value of it, that's what is get synergy in valuation, or you can say overall benefit of merger. So this is formula given by same formula, present value or value of merged entity, value of merged entity minus the value of acquirer plus the value of target. So individually, what is your value? And you add together. And what is your merged entity value? That's what I told you. Just like the cash flow, even the value of the company might be 500 rupees. A target company value might be 300 rupees. But if they're coming together means the value of merged entity may be 900. So incremental value you get 100. That's called as synergy in valuation or incremental benefit in present value. Same thing in earnings here. Here valuation. So here we talk about earnings and here we talk about value. Value, present value. Value means present value. In present value. So please make a note of this. Okay. This is also called as the overall benefits. This is the overall benefit of merger. Overall benefit of merger. Okay. Now, now regarding valuation, this value definitely in merger problem, valuation is very important. And in fact, in many exam question, even in study material, many valuation problem might be shown under merger chapter. It's very difficult to differentiate merger chapter with corporate valuation chapter, because when does valuation really arises? In case of acquisition only, right? When you want to buy shares, small lot of shares, we follow valuation of share basis. But when valuation occurs, when merger required, one company acquires another company. Byju's being valued at 46 billion, recent news, being acquired. I mean, we don't know whether they'll acquire or not. Flipkart acquired by Walmart for some big billions. Facebook has acquired some 10% stake in Reliance. Some private capital, venture capitalist acquired shares in Tata Motors, venture capitalists or private equity people, for development of electronic vehicles, EV. So when the merger takes place, then only the valuation will come into picture. But from exam point of view, in this chapter, valuation depends on information in the problem. What information we will have? Valuation may be based on most important ratio is PE ratio method. 90% of merger problem is based on PE ratio method. What is PE ratio method? The value of the company or market price per share is estimated as, MPS is estimated as earnings per share into PE ratio. I hope you know what is the meaning of P ratio. P ratio 10 means 1 rupee earning is worth 10 rupee. If you make 1 rupee profit, I will pay 10 rupee to acquire that company. The ratio between the valuation of the company and earnings of the company, that connection is given by P ratio, or market value or market cap. Market value is given by total profit after tax multiplied by PE ratio. Or sometimes they'll give you information on dividend based. And valuation formula, dividend based valuation, that is D1 by KE minus G, or cash flow based. And cash flow based means you are going to calculate a present value. 5 years cash flow given, 5 years present value calculator, or 6th year onwards they give terminal value also you might have to calculate. Remember free cash flow method, FCFE, free cash flow to earnings, free cash flow to equity shareholders, free cash flow to firm, FCFF, FCFE, that is cash flow basis. That means essentially we calculate present value method. If information is available regarding dividend, we'll use the dividend valuation model, Gordon model mostly, D1 by KE minus G. And P ratio method is 90% asked in the examination problems. That is market price per share is EPS into P ratio, or market value is PAT into PE ratio. So this formula also you must be aware of it. Please write it down. Okay, now I was telling you regarding the swap ratio. I would like to discuss that angle. Now swap ratio means what? Also called as the exchange ratio, is the number of shares issued by the issued by the acquirer for every some shares in the target company. And logically also think the swap ratio. Okay. Suppose earnings of the target company is 1 lakh and earnings of the acquirer is 2 lakh. Acquirer is having 2 lakh, target is having 1 lakh. So the ratio will be 1:2 or 0.5. Why number is less than 1? Because acquirer has got more profit, target company has got less profit. So I should issue less number of shares, right? Your target company only 1 lakh profit, a target company less value, so I should not issue more number. Think logically also, it will help you out. But anyway, now swap ratio are also called as the exchange ratio, meaning I told you. Okay, now let's think from the acquirer point of view, and let's think from target point of view. Acquirer, let's think. Acquirer point of view. Now, swap ratio from acquirer point of view, what would be the, let's talk about two things. What would be the maximum ratio and what would be the minimum ratio? Okay, now acquirer is the buyer. Acquirer is the buyer of the company. Now, given a choice, buyer, what is the minimum amount you would like to be paid? See, for example, if I give you a choice, you are buying an iPhone costing 1 lakh. But given a choice, in an ideal scenario, how much you want to pay as a buyer? As a buyer, you don't want to pay anything, right? Buyer would like to get it free of cost. Any buyer likes to have everything at free of cost. Not realistic, but ideal is that. So, what is the minimum ratio for acquirer is always 0. If given a choice, what is minimum ratio for the acquirer to acquire the company? 0. You don't want to pay any purchase consideration. Similarly, for the target company, if I divide into minimum ratio, maximum ratio and minimum ratio, maximum ratio and minimum ratio, maximum ratio for the seller is always infinity. Because I'm a seller, I how much ever I get, I'm not satisfied. I want more, I want more, I want more sales, I want more value. As a seller, I will never be satisfied. Hope you're getting the logic. It is always infinity. So minimum ratio for the acquirer, they will never ask in the examination. And maximum ratio for the target, they will never ask in the examination because they are true extremes. So the questions in exam will be, what is the maximum ratio that acquirer can afford to pay? So we have to calculate by equation, so that depends on the problem in the exam, maximum ratio such a way that earnings remain same, earnings remain same, or market value, market price remains the same. That is, by issuing shares, my earnings per share did not get affected. By issuing shares, my market price per share did not get affected. That depends on the problem. Either my earnings remain same or market price remains same. Similarly, with respect to minimum ratio as well, what is the minimum ratio to be expected by the target company will be such a way that earnings remain same, or value, that is the value of shareholder value, market value remains same. Okay, whether earnings should remain same or value should remain same, that will be given in the problem, whether earnings or value. I told or here, but which one of them will apply in exam, they should give it specifically in the problem. And acquirer and target and the actual swap ratio should be between this maximum and minimum. The merger will happen. Merger will happen only if swap ratio is between these two, minimum and maximum. For example, minimum ratio that target company is acquiring is 3:1. And maximum ratio what acquirer gives is 5:1. He will tell you maximum I'll give you 5. He will tell minimum I require 3. So between 3 and 5, merger will take place. But if minimum ratio that target company is expecting, let's say 6:1, They say I want minimum 6. They say I pay maximum 5. Then no, demand supply not happening. Merger will not take place. So merger will happen. Merger will be viable only if this maximum ratio of acquirer and the minimum ratio of target, in between that only the actual swap ratio is there. And actual swap ratio can be earnings based, can be market value based, can be book value based, or it can be average of all those. It can be simple average or it can be weighted average based on the weights given in the problem. So this is the overall concept required. Now I'm going to give you a format as well. So what and all we discussed? Basic terminology of this chapter: acquirer, target, merged entity, and importantly swap ratio, and benefits in the earnings, synergy in valuation, and how do we compute the value on P ratio method, on dividend based model, on cash flow basis, depending on whatever information available in the problem. And swap ratio can be based on various parameter, and swap ratio from the point of view of acquirer, from the point of view of target. Okay. Now I'm going to give you a simple formats. That is what format we are going to solve in problems. As 90% of the times, this format only can be applied. That is, you will have one column for acquirer. You can write the format along with me. One column for targets and one column for merged entity. And they will give you earnings or profit after tax of the acquirer. You divide by number of shares. You will get EPS of the acquirer of the target multiplied by PE ratio will give you market price per share. And sometimes the information can be in different permutations combination. That means they would have given EPS, they would have given MPS, and MPS by EPS we have to calculate P ratio. Or they will give you P ratio, they will give you MPS, we have to calculate EPS. Or they will give you earnings, they will give you EPS, we have to compute number of shares. I mean, different combinations it can apply. So this is a basic format that you have to keep it in mind. Okay. Now, one thing to be kept in mind. Okay, this and all will be given. These things will be given. Or we calculate. This is not a problem. Okay. What is most important is this number of shares issued. See, earnings of the merged entity. Okay, I'll just recalculate now. Earnings of the acquirer, earnings of the target. I'll add something. I'll write XXX. Something add. I will not get merged entity. I have to add one more thing. Sometimes they might give you, sometimes they might give you merged entity earnings directly. That is called as synergy in earnings. Synergy in earnings. That is what you get. I'll say XXX. Hope you understand. Earnings of the acquirer plus earnings of the target plus synergy in earnings due to merger. That is what earnings of the merged entity. Now, number of shares of the acquirer plus number of shares of the target, I will not get number of shares of the merged entity, because if you have 1 lakh shares of the target, that will not be 1 lakh after merger also, that will be multiplied by swap ratio. So this whatever number of shares of target, number of shares of target company, this is fine. Number of shares acquirer, no problem. Number of shares of acquirer, no problem. Number of shares of acquirer. This is not a problem, but here number of shares of targets, number of shares of targets multiplied by swap ratio, that is exchange ratio. This will give you number of shares issued. Number of shares issued. So number of shares of acquirer plus the number of shares issued, that will give you number of shares of target company. So number of shares of merged entity. Number of shares of merged entity. Number of shares of merged entity. So it will not be number of shares plus number of shares. Number of shares of target plus number of shares of target, number of acquirer is okay. Number of shares target should be multiplied by swap ratio. That will give you number of shares of acquirer which is being issued. Then together it will form number of shares of merged entity. EPS, you understand, earnings by number of shares will give you EPS. Sometimes P ratio of the acquirer, whatever P ratio of acquirer is usually assumed to be same as P ratio of target of merged entity. Of merged entity. Usually assumed, usually P ratio of the acquirer usually assumed as P ratio of the merged entity as well. Sometimes maybe a number of shares may not directly given, or the earnings may be given. So market price, to estimate market price. See, earnings of the merged entity you calculate, number of shares of the merged entity you calculate EPS, but we need market price. How do we get market price? EPS we calculated, P ratio you have to assume same, and then market price per share is obtained. Or sometimes I'll tell you, due to merger, the P ratio has fallen by 5%. So you should take the revised P ratio and multiplied by the EPS, you get the market price per share. And one more important, market value, or also called as market cap. Market value, or also called as market cap, M cap, market cap. One more term will come, free float market cap. Just be aware of it. Free float means number of shares held by public, non-promoters. That's called as free float market cap. So market value or market cap, the formula is given by number of shares into market price per share. So here what we will have, here we get market value of acquirer. Here we have market value of target, and what do you should add, or what do you get? Overall you get market value of merged entity, market value of merged entity. So what is the differential amount you get? The market value of acquirer, market value of target, market value of merged entity. This differential point, maybe balancing figure, is the synergy in valuation or overall benefit of merger. Overall benefit of merger. Overall benefit of merger. What overall profit you are getting, synergy in valuation due to earnings, synergy in earnings, saving in expenses, and overall benefit of merger will be synergy in valuation, synergy in present value. This balancing figure will be synergy in valuation, synergy in valuation, present value, synergy in present value, overall benefit of merger. So this is the format from company point of view. This is the format from company point of view. So what and all line will have? Earnings divided by number of shares will give EPS, into P ratio is market price per share, into number of shares will give you market value. Very important point is this, number of shares of acquirer plus number of shares of target, you don't add directly, you multiply it by swap ratio, that will make number of shares issued by acquirer company. So number of shares of acquirer plus shares issued, that will be the number of shares in the merged entity. Okay, hope you have taken down till here. Okay, now one more kind of question they can ask. What is that? Especially in SFM problem, you don't find that in FR problem. What is the ultimate impact because of merger? Is the shareholder happy? What is the impact on shareholder? That is a typical question you will definitely come across. So for that also, I will have one small discussion. Impact of merger on shareholder. Impact of merger on shareholder. Okay. Impact on what is a very interesting point. Impact on earnings or impact on holdings mean wealth. Impact on holdings or value or impact on earnings of shareholders or impact of impact on wealth, shareholders valuation, wealth of shareholder. We'll understand both the formulas. But in the exam, if they just mention the impact, compute the impact on shareholder, will you go for impact on earnings or impact on wealth? You should go for impact on wealth because this is the objective of financial management, wealth maximization, and not profit maximization. So this is applicable by default. If nothing specified in problem. If nothing specified in the question, we will go for impact on wealth, impact on shareholders' earnings. Okay. Impact on earnings of shareholder, very simple. Okay, let's calculate for two people. That is on shareholders of acquirer company and on the impact of earnings on shareholders of target company. Shareholders of acquirer and shareholders of target company. Okay, now on the impact of shareholders of acquirers, very simple. What will be the benefit or cost, profit or loss will be equal to EPS after merger minus EPS before merger. Very simple. EPS after merger minus EPS before merger. As simple as that. EPS before merger was 5 rupee. EPS after merger became 6 rupee. So I get 1 rupee profit. That is my benefit. How do you calculate EPS after merger? We just discussed the format. Earnings of the merged entity divided by number of shares of the merged entity. That will give you EPS of the merged entity. We have the EPS of the merged entity. We have EPS before merger, EPS of the acquirer. Right? This is EPS of the acquirer. And this is the EPS of the merged entity. EPS of the merged entity, EPS of the acquirer. Difference is benefit for the shareholders of acquirer. As simple as that. Okay, now shareholders of target company also will be same thing. Benefits will be equal to EPS after merger minus EPS before merger. EPS before merger. Okay. EPS after merger, I understand. That is EPS before merger is EPS of acquirer company, because we are, I mean, EPS of target company. We are discussing the shareholder structure of target. So EPS before merger is nothing but EPS of the target company, old company. Now, EPS of the merger is a controversial question. Interesting point. If you are having earlier one share, now you will not get one share in the merged entity. Why? Because of the swap ratio. So, how do you convert before merger and after merger? You should multiply it by swap ratio, exchange ratio. It's also called as equivalent EPS. This is called as equivalent EPS. Equivalent EPS in the merged entity. In the merged entity. Just imagine you are a shareholder of target company. You are having 1,000 shares. Now you are becoming the shareholder of new company. Will you still get 1,000 shares? No, you don't get 1,000 shares. You get, let's say, ratio is 0.5 is to 1. You get only 500 shares. So to make it comparable, when I'm writing EPS before merger is EPS of target, but after merger, you don't get one full share, you get only half share if swap ratio is 0.5. So to make it comparable, equivalent EPS, EPS of the merged entity, you should multiply it by the swap ratio. Always remember this rule. The target company shareholder, you should multiply it by swap ratio. Then only it becomes comparable. Now, same thing, impact on wealth of shareholder. I will discuss it in two ways. Shareholders of acquirer and shareholders of target. So benefit on holdings, benefit in valuation will be MPS after merger minus MPS before merger. MPS after merger minus MPS before merger. And MPS after merger is MPS of the merged entity. MPS before merger is MPS of the acquirer. Same shareholders target, that is shareholders of target, it will be MPS after merger. But you don't just take MPS after merger, the target company shareholder in the merged entity, you will not get one full share. You get only swap ratio. So you multiply it by swap ratio. This will be equivalent market price per share, equivalent MPS minus MPS before merger. Before merger means MPS of the target. MPS before merger. This whole structure, see, this I wrote so much. Only one formula you have to remember. After merger minus before merger. After merger for the target company shareholder, you have to multiply it by swap ratio. That's all. I wrote so much. Only one sentence you have to remember. It is after merger minus before merger for a target company. After merger should be multiplied by swap ratio. That's all you should remember. But for your comfort, I wrote the formulas. Okay. Hope you have taken down. Any doubts? Okay. Continuation with one more small point regarding this. Earnings should be remaining same or value should remain same. We might have to calculate the exchange ratio, either maximum or minimum. That formula I would like to discuss. Again, conceptually, if you remember, you don't have to buy heart, but still, just for discussion purpose. Okay, let's think from this maximum minimum exchange ratio, swap ratio, or exchange ratio. See, from the point of view of acquirer, from point of view of acquirer, and from point of view of target. Okay. Now, from the point of view of acquirer, I told you minimum ratio will not calculate because it will be zero only. So, we have to calculate maximum which acquirer is ready. Similarly, from the point of view of target, it is the minimum that we should be ready, minimum ratio for target company point of view. Now, as I told you, the swap ratio in the exam can be asked to maintain the earnings or to maintain the market price per share. To maintain same earnings, to maintain same EPS, no impact on EPS. To maintain same market price per share. What do you mean by this? Are you understanding what is the maximum swap ratio where your EPS will not change? You remember what I just discussed? The shareholders of acquirer benefit EPS of the after merger minus EPS before merger. The benefit what I calculated, what is that point where benefit is zero? Like a cutoff point, like a indifference point. I will get same EPS. Two situations. To maintain same EPS. To maintain same EPS means EPS before merger should be equal to after merger. So I will write EPS of EPS before merger, or that is EPS of uh, acquirer should be equal to EPS of target. EPS of acquirer is equal to EPS of target. I mean, not target, merged entity. EPS of merged entity. EPS of acquirer is equal to EPS of target. And how do you calculate? I mean, format already given you, but still, it will be how much? Earnings of acquirer plus earnings of target plus synergy benefit divided by what? How did you calculate? Divided by what? Divided by uh, number of shares of the merged entity. So numerator is earnings of the merged entity, earnings of acquirer plus earnings of target plus energy benefit, which means numerator is earnings of the merged entity divided by number of shares of the merged entity. How much it will be? That number of shares of merged entity. How do you calculate number of shares of acquirer plus the number of shares of targets? No, I cannot calculate the number of shares of target just like that, because number of shares of target should be converted into number of shares of merged entity. For that, what should I do? I should multiply it by swap ratio. I should multiply it by swap ratio. And this swap ratio, you have to calculate, you have to simplify this equation. EPS of the acquirer equation is simple, equation use simple, that is the swap ratio, you will get the maximum exchange ratio. And if no synergy benefit, one shortcut I'll tell you, if no synergy to maintain same EPS, if no synergy, then I'll give you a shortcut. This formula you don't have to apply. If no synergy, then you can do swap ratio based on EPS. If there is no synergy, then don't apply this formula. Straight away go for the swap ratio based on EPS TAR. Shortcut I told you TAR. That is earnings of the target by earnings of the acquirer. You get the formula. You get the swap ratio to maintain same EPS. When there is no synergy. If there is synergy, then you have to follow this process. Okay, now to maintain same MPS, to maintain market price per share, same thing. What I should do here? Here I told you EPS of acquirer is equal to EPS of target. Here it will be MPS of acquirer will be equal to MPS of target. But I don't do, MPS of target, how do I do it? MPS of target will be, sorry, MPS of merged entity. MPS of merged, MPS of acquired should be after merger also. MPS of merged entity. How do I calculate MPS of merged entity? EPS of merged entity multiplied by P ratio of merged entity. How do you calculate EPS of the merged entity? That is, what is this same thing? Right? We already calculated this whole process. Same thing. EPS of the merged entity. You can use that formula only. P ratio of the merged entity usually will, if nothing is given, then it will be, if nothing is given, usually assumed as, usually, if, or they will be given, okay, they will given. PS of the merged entity will be given. If it is not given, we assume it is same as acquire. So you simplify to maintain the same EPS. So that is from the point of view of acquirer. Now from the point of view of target, same logic, only one small change will come. I hope you know what is that change. Anyway, I'll tell you. To maintain same EPS, to maintain same MPS. So what formula I'm going to do? Same thing, EPS of the acquirer, in this case EPS of the target should be equal to EPS of acquirer. Will I take EPS of acquirer? No. What will I do? I multiply it by swap ratio. Hope you understand. Your EPS of the merged entity, EPS of target is equal to EPS of the merged entity multiplied by swap ratio, that is equivalent EPS comparable with EPS of the target, and EPS of the merged entity will be same formula. And to maintain MPS, same thing, that is MPS of target company share price should be equal to MPS of acquirer, MPS of merged identity, that is after merger, multiplied by swap ratio. So whenever comes to target shareholder, don't take EPS directly, don't take MPS directly, multiplied by swap ratio, that only makes comparable number. And how do you calculate the market price per share? As I just calculated previously, MPS will be EPS into P ratio, again as we calculated in the previous section. So only one formula you remember. Earnings of the acquirer, earnings of the target, plus energy benefit divided by number of shares of acquirer, number of shares of target into swap ratio. And it's also not a formula to be by hearted. It's earnings of the merged entity divided by number of shares of the merged entity. And whenever a target shareholder comes, you multiply it by swap ratio to make it comparable. That's all what you have to remember. I hope you are not by hearting the formula. I'm trying to explain in the most logical, structured way possible so that you don't by heart the formula. But in case you want to relook at the formula while solving the problems, I'm writing the formula for you. It's only for reference purpose. Ideally, everything logic should flow in your mind. Okay. Now, there is one more way of calculating a benefit of merger from total company point of view. That formula also I would like to discuss. Not required actually, but because we have discussed anyway on impact of merger and shareholder, this will take care of everything. But still, in some institute solution, you might see that steps. So I would like to discuss with you. Uh, Benefit of merger calculation or impact of merger, total point of view, not per share, total basis from acquirer shareholder point of view, acquirer shareholder point of view, from target company shareholder point of view, from target company shareholder point of view. Okay, total basis. This is total basis, not per share basis, total basis. So what you are going to do, I will take the merged entity value, merged entities market cap, merged entity market value. In the merged entity, acquirer shareholder is there, target shareholder is also there. So proportionately you calculate. That is value of, after merger minus before merger. Okay. Now before merger means value of acquirer, means before merger, value of acquired entity or market value of acquirer. This is before merger. After merger means market value of merged entity and take proportionate amount. Market value of merged entity multiplied by proportionate amount. The proportionate shareholding. That is number of shares of acquirer divided by number of shares in merged entity. Basically tells you proportionate shareholding. Proportionate shareholding. Same thing. From target company point of view, I will write after merger minus before merger. After merger, before merger is market value of targets After merger will be market value of merged entity multiplied by number of shares of target company, number of shares issued, I'll say number of shares issued to target company shareholder divided by number of shares in merged entity. Difference, of course. And this again is proportionate shareholding. Usually you don't worry about this method. In fact, we have calculated already, right, on per share basis, MPS of the merged entity minus MPS of the acquirer. That is per share basis. If you multiply by number of shares, you get the same answer. But anyway, just for your reference, I told you impact of merger on total basis, total value basis, and not per share basis. You can do after merger, what is the proportionate shareholding value minus the market value of the merged entity. Okay. Some other small terms you should be aware of it. I will write it that so that after this summary part will be completed. I hope you have taken down till here. Some small other terms they can ask in exam. Very rare, but you should be careful. Okay, I'll just write it. Other terms they can ask you value of acquisition. Sometimes they'll use this term value of acquisition. Basically from merger point, from acquirer point of view actually. From acquirer point of view. That is nothing but value of merged entity minus value of acquirer. So basically with merger, without merger. Value of acquirer means without merger. They will give you something. With merger, so much of cash flow you get. Without merger, that is independent entity, they will give you this. Without merger, independent entity. They'll give you cash flow, cash flow. So based on the independent cash flow, compute the value of the company. Based on the merged entity cash flow, compute the value of the company. Difference. So with merger, without merger. So the difference is the value of acquisition. Sometimes they can ask you. This is with merger. Value of acquisition. And they'll ask you cost of acquisition, true cost of acquisition, true cost of acquisition. True cost of acquisition is nothing but amount paid, that is benefits paid, nothing but purchase consideration, that is number of shares issued into market price per share of merged entity, market price per share of merged entity. And how do you calculate the number of shares issued? You will have number of shares of target multiplied by swap ratio. Number of shares of target multiplied by swap ratio is the market price per share of the merged entity. And sometimes they call apparent cost. Apparent cost of acquisition. Apparent cost will be exactly the same thing, same formula. That is number of shares issued, but you don't multiply it by MPS of the merged entity, you multiply it by MPS of the acquirer. See, if you think from the target company point of view, oh, that company is taking over this company, that means their market price what we are getting apparent cost. But after merger, what will be the impact is your true impact. Did you get my point? Even if you remember in all the impact, what we calculate, impact on shareholder point of view, acquirer point of view, to maintain EPS, to maintain MPS, in all these ratios, all these calculations, what we calculated? We always took the market price per share after acquisition, that is of the merged entity. That will be the ultimate impact. But before merger, many people will not see that. What they see? Oh, MPS of the acquirer. That company is taking over. That company MPS I'll take. So when I take MPS of the acquirer, I will get apparent cost of acquisition, but true impact is only known after merger. So when I take MPS of merged entity, that is called as true cost of acquisition. And sometimes they can ask you overall benefits or the net benefit for the acquirer. Net benefit for acquirer is whatever the value of acquisition, that's the benefit you're supposed to get, minus true cost as we calculated. That is net benefit for acquirer. So these other terms are not very popular. Only few times, 1 out of 5, 6 attempt they'll ask, but they can still ask. So I've given you the list of formulas on that. So net benefit for the acquirer is value of acquirer, like value of acquisition, what I calculated here, minus true cost, what I calculated here. The difference is the net benefit for the acquirer. This is what benefit you're supposed to get, and you paid some amount. So you receive some, you pay some, net benefit is this true cost. Okay, so all possible formulas, what can come, I have discussed here. Okay, so again, this should give you a very good base regarding all the formulas in one place. So when you solve the problems, when you're doing revision, please use this as a reference point. Okay.